Number 5. Tax traps that can cost you six figures before you retire. Fix them now. There are 5 things sitting in your financial life right now that the IRS is going to tax the moment you retire. Not because you did anything wrong, because of where they are. And the window to fix them is closing faster than most people realize. A viral video with millions of views told people to sell their house, sell their car, declutter their life before retirement. That is lifestyle advice. It might feel good, it might simplify things, but it will not save you $1 in taxes. What you're about to read is completely different. These are 5 specific financial positions, real assets sitting in real accounts, that the IRS treats very differently depending on whether you restructure them before your last paycheck or after. The difference is not small. It is not theoretical. It is not a rounding error. It is 6 figures over a 25-year retirement.
If you are within 5 years of retirement, this is one of the most important tax strategies you will ever learn, because every single one of these 5 moves becomes dramatically more expensive or completely impossible after you stop working. Your tax brackets change. Your income flexibility disappears. Your Medicare IRMAA look-back locks in. And by the time most retirees realize what they should have done, the window is already shut. Before we get into it, I need to be clear. I'm not a lawyer, not a CPA, not a financial advisor. Nothing in this information is legal, tax, or investment advice. These are educational examples based on current tax law and publicly available IRS information. Always consult a qualified tax professional before making decisions about your specific situation. If this is your first time reading content like this, it's built for one specific group: retirees and pre-retirees over 60 who want to understand how the IRS actually works in retirement. Not the version your HR department gave you. Not the version your financial advisor glossed over. The real version with real numbers in plain English. Drop a mental note right now. How many years until you retire? Just the number, 1, 3, 5, 10, whatever it is, because that number determines how urgent these 5 moves are for you. The closer you are, the faster you need to act. Let's get into it. Number 1, sell your high turnover mutual funds in your taxable brokerage account. This is the silent tax leak that drains tens of thousands of dollars over time, and most people never notice it. If you own actively managed mutual funds in a taxable brokerage account, not inside an IRA or 401k, but in a regular taxable account, you are paying taxes every single year, even if you never sell anything. Here's why. Inside those funds, the manager is constantly buying and selling stocks. Every time they sell a winner, it creates a capital gain. At the end of the year, those gains are distributed to you. You owe taxes on those gains even if you never sold a share, never touched the money, and didn't even know it happened. The IRS still sends you a 1099 you still owe. Many actively managed funds have turnover rates of 80% to 120% per year. That means most of the portfolio is being replaced annually. Every replacement creates a taxable event. The tax drag from high turnover funds can easily be 1% to 2% of your account per year. On a $200,000 taxable account, that's $2,000 to $4,000 per year. Over 10 years, $20,000 to $40,000. Over 25 years, $50,000 or more. And you never saw a bill. It just quietly reduced your wealth. The fix is to transition those funds into low-turnover, tax-efficient index ETFs. But timing matters. While you're working, you're likely in a higher tax bracket. After retirement, your income may drop enough to qualify for 0% capital gains tax. In 2026, single filers under approximately $49,450 taxable income pay 0% on capital gains. Married couples under approximately $98,900 pay 0%. That means you can sell appreciated assets and pay 0 federal tax. The strategy is to sell small gain positions now while working. Then wait to sell large gain positions in your first low-income retirement year when you can harvest those gains at 0%. Replace everything with tax-efficient ETFs. Once you switch, the tax bleeding stops immediately. One viewer emailed recently who had held a high-turnover international fund in his taxable account for 12 years. He never looked at the tax drag. When he pulled his 1099s for the last 5 years and added up the capital gain distributions he had been taxed on, the total was over $11,000 in taxes paid on gains he never chose to realize. He moved it to an index ETF in one afternoon. The bleeding stopped that day. Number 2. Convert your traditional IRA to Roth. Before it's too late, every dollar in your traditional IRA is a dollar the IRS hasn't taxed yet. They are going to get it. The only question is when and at what rate. If you do nothing, your IRA grows and compounds. At age 73, required minimum distributions begin. You are forced to withdraw money. Every dollar is taxed as ordinary income. By then, you also have Social Security, possibly a pension, and investment income all stacking together. Your effective tax rate on those withdrawals can hit 30% to 40% when you factor in federal tax, Social Security taxation, and Medicare IRMAA surcharges. The alternative is converting part of your traditional IRA to a Roth before retirement or during early retirement years. These are called gap years. No salary, no RMDs yet, possibly no Social Security. Your income is at its lowest. In 2026, a married couple filing jointly can fill the 12% bracket with roughly $129.50 of taxable income after deductions. If your only income during the gap years is controlled IRA withdrawals, you have enormous room to convert at 12% instead of 22% or higher later. Let me put a number on this. A couple who converts $300,000 over 5 gap years at 12% pays about $36,000 in federal taxes on the conversions. That same $300,000 left in the traditional IRA and forced out as RMDs at an effective rate of 25% over 20 years cost them $75,000. The conversion saves $39,000 on the same money. But here's what makes this a before-you-retire move. While you're still working, your salary fills the 12% bracket. There's no room for conversions at low rates. Every conversion dollar gets stacked on top of your salary and taxed at 22% or higher. Your last year of work is too late for big conversions. You need to plan the timing so the gap years begin when your salary stops. If you are within 3 years of retirement, talk to a tax planner this month. Not next year, this month, because Roth conversion planning requires modeling multiple years of income exposure and Social Security timing. It cannot be done in April when the return is due. There's also the interaction with Medicare, ERMAA. Every dollar you convert from a traditional IRA to a Roth counts as income. The 2-year look-back means a conversion you do in 2026 can spike your Medicare premiums in 2028. For single filers, the first IRMAA tier starts at $106,000. For married couples, $212,000. If you are doing conversions, you need to model the IRMAA tiers year by year to make sure you are not saving $12,000 in income tax while spending $4,000 in extra Medicare premiums. The math still usually favors the conversion, but you need to know the full cost before you pull the trigger. Number 3. Harvest capital gains at 0%. While you still can. This is one of the most powerful and most underused tax strategies in retirement. In the right income range, you can sell investments and pay 0 federal tax on the gains. In 2026, if your taxable income is below $49,450 as a single filer or $98,900 as a married couple, you pay 0% federal tax on long-term capital gains. 0. That means if you own individual stocks or ETFs in your taxable brokerage account that have appreciated significantly, you can sell them, pay no federal capital gains tax, and immediately buy them back. You have just reset your cost basis to the current value. When you sell them again years later, the gain is calculated from the new higher basis. You eliminated years of embedded gains without paying a penny in tax. The strategy is called capital gains harvesting. It is the mirror image of tax loss harvesting. Instead of selling losers to offset gains, you are selling winners when your income is low enough to pay 0 on the gain. But here is why it has to happen before or immediately after you retire. The The 0% rate only applies when your taxable income stays below the threshold. Once Social Security starts, once RMDs kick in, once your pension begins, your taxable income climbs above the threshold and the window closes. For most retirees, the 0% capital gains window exists for only 3 to 5 years maximum. If you have a stock you bought 20 years ago for $10,000 and it is now worth $60,000, that is $50,000 in embedded gains. Selling it while your income qualifies for the 0% rate saves you $7,500 in federal taxes compared to selling it later at 15%. On a single position, if you have multiple positions with embedded gains, the savings multiply. Your last year of work and your first 2 or 3 years of retirement are the sweet spot. After that, the window is usually gone. Let me give you a concrete example. A married couple retires in January 2027. In 2027, their only income is $30,000 from controlled IRA withdrawals. Their taxable income after the standard deduction is well below the $98,900 threshold. They own 3 stock positions in their taxable account. Position A, cost basis $15,000, current value $40,000, embedded gain $25,000. Position B, cost basis $8,000, current value $22,000, embedded gain $14,000. Position C, cost basis $20,000, current value $35,000, embedded gain $15,000. Total embedded gains $54,000. They sell all 3. Total capital gains $54,000, federal tax at 0%. 0. They immediately buy similar but not identical ETFs with the proceeds. Their new cost basis is the current market value. If they sell those same positions in 10 years when their income is higher, the gain will be calculated from the new higher basis. They just erased $54,000 in future taxable gains without paying a penny. If they had waited until age 75 to sell those positions when their RMDs and Social Security are pushing their income above the threshold, the 15% capital gains rate would have cost them $8,100 in federal taxes on the same $54,000 in gains. That is $800 saved by selling 2 years earlier. And one important note, unlike tax loss harvesting, capital gains harvesting does not have a wash sale restriction. The wash sale rule only applies to losses. You can sell at a gain and immediately buy back the same security. However, most advisors recommend buying a similar but not identical fund to ensure the transaction is clearly documented as a separate purchase for cost basis purposes. Number 4, move bonds and REITs out of your taxable account. This is about asset location, not asset allocation. The distinction matters enormously and almost nobody gets it right. Asset allocation is what percentage of your portfolio is in stocks versus bonds. Asset location is which account those investments sit in. And the IRS treats different account types very differently. Bond interest is taxed as ordinary income. REIT dividends are taxed as ordinary income. If those investments are sitting in your taxable brokerage account, every dollar of interest and every dollar of dividends gets added to your adjusted gross income. That income pushes your provisional income higher, which pushes more of your Social Security into the taxable zone. It can trigger IRMA surcharges. It increases your state tax bill. The same bond fund or EIT sitting inside your traditional IRA generates the exact same income, but you do not pay taxes on it until you withdraw. Inside a Roth IRA, you never pay taxes on it at all. The strategy is straightforward. Before you retire, sell your bond funds and REITs from your taxable account. Buy them inside your IRA or Roth IRA. In the taxable account, hold tax-efficient index stock ETFs that generate mostly long-term capital gains, which are taxed at lower rates or potentially 0%. The dollar impact of correct asset location can be 0.5% to 1% of your portfolio value per year in reduced taxes. On a $500,000 portfolio, that is $2,500 to $5,000 per year. Over a 25-year retirement, that is $62,500 to $125,000 for moving the same investments between accounts. The allocation does not change. The risk does not change. The tax bill changes dramatically. Why do this before retirement? Because while you're working and contributing to your 401k or IRA, you have natural inflows to purchase the bonds and rates inside the tax-sheltered account. After you retire, there are no new contributions. You have to sell and rebuy, which can trigger taxable events. It is cleaner and cheaper to get the location right while money is still flowing in. Number 5. Relocate to a low tax or no tax state. I know moving sounds extreme, but the math is not extreme. It is straightforward, and for some of you, it is the single biggest financial decision of your retirement. 9 states have no income tax at all: Florida, Texas, Tennessee, Nevada, Wyoming, South Dakota, Alaska, New Hampshire, and Washington. 3 more states, Pennsylvania, Illinois, and Mississippi, have income taxes but exempt all pension and retirement income. That means IRA withdrawals, 401k distributions, pension payments, and Social Security are all state tax-free. Compare that to California, where retirement income is taxed at rates up to 9.3%. Or New York, where everything above $20,000 in pension income is fully taxable. Or Minnesota, which still taxes a portion of Social Security benefits at the state level. Or Connecticut, which phases out its Social Security exemption above $75,000 for single filers. For a retiree with $60,000 in annual income, the difference between California and Florida is roughly $3,500 to $4,500 per year in state taxes. Over a 25-year retirement, that is $87,500 to $112,500. That is not a lifestyle choice. That is a financial decision with a 6-figure consequence. But here's why this move has to happen before or immediately at retirement. Many states have residency rules that require you to establish domicile, change your voter registration, update your driver's license, and spend a majority of the year in the new state. If you wait until you are 73 and your RMDs are pushing income higher, you are paying the high state tax rate for every year you delayed. Each year of delay costs you the full annual difference. And here's one more layer that nobody is connecting. Roth conversions are dramatically cheaper in low-tax states. In California, the effective rate of a Roth conversion can be 21% to 23% when you combine federal and state. In Tennessee, it is 12% flat. The difference on a $100,000 conversion is $9,000 to $11,000 in a single year on a single conversion. I am not telling everyone to move. If your family is in California and your grandchildren are in New York and your life is built in Minnesota, do not uproot your entire existence to save on taxes. But if you were already considering a move, if you were already thinking about warmer weather or lower cost of living, add the tax number to your decision. For a lot of you, it will tip the scale. Bringing all 5 together. Let me bring all 5 together with one example. Imagine a married couple, both 63. They have $400,000 in a traditional 401k, $150,000 in a taxable brokerage account, and they live in California. They plan to retire at 65. Move 1. They sell their high-turnover mutual funds in the taxable account and replace them with tax-efficient index ETFs. Annual tax drag eliminated, approximately $2,000 per year. Lifetime savings, $50,000 over 25 years. Move 2. They begin Roth conversions in their first year of retirement. They convert $50,000 per year for 5 years at 12% instead of waiting for RMDs at 22% or higher. Tax savings on conversions, approximately $25,000 over 5 years. Move 3. In their first year of retirement, when their income drops, they harvest $60,000 in embedded capital gains at 0%. Tax avoided, $9,000. Move 4. They move their bond allocation from the taxable account to the IRA. Annual tax savings from correct asset location, approximately $2,000 per year. Lifetime savings, $50,000 over 25 years. Move 5. They relocate from California to Tennessee at retirement. Annual state tax savings, approximately $4,000. Lifetime savings, $100,000 over 25 years. Total estimated lifetime savings across all 5 moves, approximately $234,000. Same couple, same money, same retirement. $234,000 more in their pocket because they restructured 5 financial positions before the window closed. And here is the part that should make you uncomfortable if you have not done any of this. Every single one of those moves is legal. Every single one is well documented in the tax code. The IRS does not prevent you from doing any of them. But the IRS also does not tell you they exist. Nobody calls you at 63 and says you should probably convert your IRA before your gap years end. Nobody sends a letter saying your mutual funds are bleeding $2,000 a year in unnecessary tax drag. Nobody warns you that your bond funds are in the wrong account. The system is designed to collect the maximum from people who do not ask questions. These 5 moves are the questions. Here is what you should do right now. 3 things. First, pull up your taxable brokerage account. Look at what you own. Are there high turnover mutual funds in there? Are there bond funds or REITs generating ordinary income? Those are positions 1 and 4. Fix them. Second, look at your traditional IRA or 401k balance. If it is above $200,000, you need a Roth conversion plan before you retire. That is position 2. Talk to a fee-only tax planner. Not next year, this year. Third, calculate your embedded capital gains. Look at the cost basis of your taxable holdings. If there are large gains and you're within 2 years of retirement, plan the harvest for your first low-income year, that is position 3. The 0% window does not last long. Think about which of these 5 moves you've been ignoring. That answer might be worth 6 figures. The difference between retiring comfortably and constantly worrying about taxes is not how much you saved. It is how well your money is positioned before retirement. Because once the window closes, you do not get it back.